Hi, welcome to Market in a Minute. I'm Patrick Adams. The technicals for the market, and in particular the technology sector, are starting to teeter. So we thought it'd be a good time to review what's going on in tech and also the major issues of the market. Then we're going to talk about what Stanley Druckenmiller put out early in the year to track what he was talking about to see where we are in his thought process. And then what's hitting the tech group really hit it hard last week was these cheaper AI models coming out of China. So the Kimi K3, we're going to talk about that and how that could be competitive, very, very competitive at this point at a much lower cost, free. So disclosures, please read that at your convenience. The market update. So we're going to walk through the issues that we see in the overall markets that we think are important that we've been talking about. So as everybody knows, if you watch our videos or read Mark in a Minute, that technology is a very large part of the overall S&P 500. So technology and related are about 50% of the overall stock market. That's a high weighting, historically very, very high. Capital spending is what's driving it. So not so much the usage of AI, but building out the AI platforms that's where all the money's going right now, and that's what's driven the semiconductors up so much. There may be a cheaper way of doing this. We all knew it was going to be a solution to come around at some point. So flipping down to this little section here, the cheaper Chinese AI models. Okay, so the Kimi K3 model. Okay, this was reviewed by Databricks. The CEO of Databricks, very respected company that's private, that's going to go public. That could be a big winner, by the way, at some point in time. So they say that it's just below in terms of performance Anthropic and OpenAI. In our opinion, that's quite a statement, but it costs less money than both of those platforms. So basically, being free, it's gathering these models. These Chinese models are gaining a lot of market share. Cheaper or free, gaining a lot of market share. It's less expensive to build these data centers over in China, so they're very competitive. So that's one major concern. Now, the inflation is also a major concern of the overall markets. So inflation for June came in at 2.6%. Core inflation, that's fine. That's not at 2, but it's fine. The CPI at 3.5%. The all inclusive, all the items in CPI run at 3.5%. So obviously that includes energy as well. So that's still elevated. So where treasuries are currently trading, so the 2-year treasury at around 4.2%, are indicating that the bond market expects the Federal Reserve to raise the Fed funds rate from 3.6, where it is currently, to at least once or maybe twice from this point. We think it all centers around that all CPI report at 3.5%. It's coming down, but it's not coming down far enough probably for the overall bond market at this point. So the bond market is starting to anticipate rates, maybe going higher on the short end. Oil prices need to come down. So this is the major issue we see it. Oil prices now above 80. That's not good. So we need to see oil prices trending back lower. We got as low as 68. That's fantastic. So we need oil prices lower to keep the inflation down, to help the overall bond market be more convinced that inflation is not an issue, and let the Federal Reserve, so instead of thinking about tightening, that they're thinking about cutting interest rates because inflation is under control. Now we believe that the Treasury is running currently 4.4% to 4.6. We believe that it's critically important that the 10-year Treasury doesn't go much above where it is. If it goes to 5, it kills the overall market. And then margin debt's very high, so that hot money can be moved around very quickly. Again, if we have a problem in technology, we're 50% of the overall market. That hot money moves around. That could be very damaging to the overall stock market. So in the short term, the technicals are weakening in front of an August and September that tends to be very weak seasonally. So even sometimes in October, that could be a very weak period as well. So we're entering kind of a weak seasonally period for the markets, and that didn't have any impact last year actually. The seasonality had no impact on the overall markets. So some years it does, some years it doesn't. But that tends to be historically the two weakest months of the year. So on Wednesday, we get the Google earnings report. So they should talk about their plans for AI spending. Okay, so hopefully they give some guidance on that. And hopefully it doesn't change too much, otherwise the market's not going to like that at all. So what's happening is we think we're kind of in the middle innings, or maybe even pushing out to late innings, who knows, because companies they're selling stock and they're issuing debt to build out these data centers as quickly as possible. Generally, when that happens, then we're kind of, we're deep into the cycle of this build out. So on Wednesday, we get Google earnings report. And the other thing to watch is their new chip. So hopefully they're going to talk about that. They have a new AI chip coming out in 2028, which could be a much cheaper solution than what's currently out there with the NVIDIA chip. Now, Stanley Druckenmiller put out his thoughts of why we were going to go into a bear market back in, I think it was around February of this year. And his key points are that the Fed is stuck because of inflation. They can't cut rates. Well, we're still there. Maybe that changes as the outlook on oil changes, but we're still stuck there. So give him that. The government debt's too high. How true that is, okay? If for instance, if Japan repatriates $1 trillion or more, that might actually push the 10-year Treasury up over 5%. Who knows? Maybe that's not quite enough money to do that, but it'll have some sort of impact. So we would say, okay, the jury's still out on that one. The regional banks was another thing that he talked about, having credit issues and the regional bank index falling. That's not happening. Here's the regional bank index. It's strong. The credit quality so far, the earnings reports we've seen, looks just fine. We think maybe improving. So that's not an issue at this point. And then the credit spreads, I'm surprised actually they haven't moved up a little bit more, but the credit spreads on junk bonds versus the government bonds, even with the retail investors not being able to redeem out of some of these private debt funds, we're not seeing much of an impact at all on these spreads. So Druckenmiller's views are just not panning out at this point in time. But I thought it was a good time to review everything. We believe the two issues that are impacting the markets and could cause a problem. It's Iran and now the sanctions on oil, okay, causing oil prices to stay high and inflation to stay high. The longer that goes, the harder it is for the market to go up. So that's a problem. So we think it prevents interest rates from falling, and inflation falling, interest rates falling, and a sustained, lasting rotation into the rest of the overall markets, like the consumer area. So we've been stuck in this AI trade, capital spending environment of technology, and the market hasn't felt comfortable enough to, on a sustainable basis, rotate into the rest of the overall markets. And so obviously what's a big issue is the size of the weighting of technology in the S&P 500, and having that high margin debt. Obviously that's financing the purchase of stocks in that group. So those two are the main issues: inflation and then the high weighting of technology, the overexuberance of technology in general. Now the technicals, in my opinion, all that's good talk. We know what the issues are, but what's really going to drive everything or tell you what to do in the near term is the technicals. So if the technicals break down, that's gonna be a big problem for the overall market. So again, we need a good report out of Google on Wednesday, and we'll see how the technology stocks perform. And we kind of seen this before. Micron had a good quarter. The tech group rallied nicely, and then Google needs to have a good quarter, and then we're going to get a whole bunch of other tech coming. So Google's not necessarily going to set the trend, but it'll be important to holding where we are in terms of the support level where technology is currently. So the technology stocks index, the XLK, okay, ETF that tracks the technology sector, broke the 20-day and the 50-day moving averages and is right at the support level. So if we lose that, expect much more downside. Then it's going to hit the S&P 500. There's no way out of this really if the tech group goes down, and without lower rates, the interest rates, then the technology sector is going to push the overall S&P 500 down. So on the S&P 500 down, again, we're just slightly below the 50-day. So if the technology sector breaks, it's going to knock the overall S&P 500 down. So we're at a critical level. I would describe the risk profile of the overall markets now as being high. It's high because of the concentration risk in technology and the lack of any progress on inflation. So it's what we did in our portfolios last week is we took some profits, we raised some cash, and we added some hedge in the overall portfolio. So not a lot, but we added some hedge to protect against the downside, to be a little bit more conservative. Probably what will happen is Google will have a good report, the tech group will rally, and the S&P 500 will hold in there. But if it doesn't happen, then there's considerable downside risk in the overall markets. So if you have any questions, always please ping me. Come to my website, Patrick Adams CFA. You can sign up for a hard copy of Market in a Minute. And then also, please look at the strategies we have over PVG. We got some great strategies. We call them loss-averse investing. Even if it is an aggressive portfolio, we can manage it in a loss-averse manner. Take care.